This episode talks about a book called One Up on Wall Street: How to Use What You Already Know to Make Money in the Market. Before we get started, please click on the subscribe button below to stay updated. Peter Lynch is one of the world's most successful fund managers. How successful? Some say his contributions to the fund industry are akin to Michael Jordan's contributions to basketball. The Magellan Fund, which he managed, achieved an annual compounded return of 29%, breaking the record for the U.S. mutual fund industry. In this book, Peter Lynch discusses his complete set of principles and methods for stock selection, essentially revealing the secrets that made him the most successful fund manager. One of his most acclaimed methods is his strategy for picking Tenbaggers, stocks that can increase tenfold over 10 years, which he elaborates on in detail in the book. Investment guru Warren Buffett has always held Peter Lynch in high regard. Shortly after this book was published, Lynch received a call from Buffett, who said, "I just finished your book, and I loved it." Receiving such praise from Buffett is a testament to the book's remarkable insight. Next, I will detail Peter Lynch's complete investment strategy, divided into three key principles: identifying Tenbaggers, stocks to avoid, and mastering the timing of trades. Part 1. Let's first look at the first principle, picking Tenbaggers, which are stocks that rise more than tenfold in a relatively short period. During his investing career, Peter Lynch placed great emphasis on finding Tenbaggers, likely influenced by his first stock purchase. In his sophomore year of college, he bought shares in Flying Tiger Airlines at $7 per share, which rose above $30 within 2 years. This early success confirmed his belief in seeking out major stock gains, which he pursued throughout his career. Lynch boldly stated in the book that ordinary, amateur investors have an advantage over professional investors in identifying Tenbaggers. It may sound shocking, but Lynch's exact words were even more exaggerated. 20 years of experience in the business has convinced me that with just 3% of their brain power, any ordinary amateur investor can achieve returns surpassing the average performance of Wall Street professionals. This is truly inspiring for millions of ordinary people, but inspiration alone is not enough. In the book, he elaborates on why he believes amateur investors have an edge in stock selection. A crucial reason is that Wall Street professionals often exhibit lag in their actions. Lynch pointed out that professionals on Wall Street usually wait until many renowned analysts recommend a stock and their peers start buying heavily. For example, a clothing company listed in 1969 went unnoticed initially. 6 years after its IPO, when it had opened 100 stores across the United States, only one institutional investor had bought its stock. 4 years later, only 2 institutional investors were involved. 14 years after its listing, with hundreds of stores and thriving business, the company's stock price had increased 18-fold to $9, but it still hadn't attracted significant attention from Wall Street. 2 years later, when the stock price had risen 30-fold to $15, it finally began to draw significant attention from institutional investors on Wall Street. Lynch believed the delay by professionals was due to their reluctance to take risks on unknown, smaller companies. He used a vivid example. If you buy IBM stock and it declines, your clients and boss might ask, "What's going with IBM lately?" But if you buy stock in an obscure motel company and it declines, they will ask, "What's wrong with you?" The pressure of buying unknown companies makes independent thinking very difficult among professional investors. Therefore, Lynch advised continuing to think like an amateur investor when selecting stocks. So, how should an amateur investor choose stocks? According to Lynch, the best places to look for Tenbaggers are in your own backyard, or if not there, then at large shopping centers or workplaces. Imagine someone living in rural America in the 1970s, growing their own food and without a TV. Where could they find a Tenbagger? Perhaps one day, you suddenly experience stomach pain and must see a doctor because rural life has given you a stomach ulcer. leading you to discover a tin-bagger in the form of Schick Pharmaceuticals, a company well known for its effective stomach medicine, Tagamet, which became a bestseller after its launch. Schick Pharmaceuticals thus became a tin-bagger. It might seem easy to find a tin-bagger, but don't get too excited yet, because the truth is most people don't manage to do it, and even Peter Lynch regretted missing out on big winners in his own industry. In 1977, Lynch was working at Fidelity Funds during a boom period for the fund industry, with many companies going public. For example, the Dreyfus Fund, whose stock price was 40 cents in the 1970s, rose nearly 100-fold to about $40 by 1986. Lynch, despite being well acquainted with the industry, missed out on this opportunity. It seems common for people to avoid stocks in their own industry or those they are particularly familiar with. Lynch described this phenomenon. If you survey doctors, I bet only a small portion own pharmaceutical stocks, while most likely own oil stocks. If you survey shoe store owners, most probably own airline stocks instead of footwear stocks, and conversely. Aerospace engineers might own more footwear stocks. It's a paradox that people always think the grass is greener on the other side. To successfully pick tin-baggers from your surroundings, you first need to overcome the misconception that others' grass is greener and then find a way to leverage your own advantages. How should you do this? Lynch further divided companies into 6 categories: slow growers, steady growers, fast growers, cyclical, hidden assets, and turnaround situations. Hearing these categories might make your head spin, but don't worry, the real opportunities for tin-baggers are mainly in 3 types of companies: fast growers, hidden assets, and turnarounds. When analyzing a specific company, different types of companies require different analytical approaches. We'll now focus on the 3 types most likely to produce tin-baggers. First, let's look at fast-growing companies, which are the most fertile ground for tin-baggers and Lynch's favorite type. These companies are often newly established, small, and have good growth potential, with an average annual growth rate of 20% to 25%. If you can identify good candidates within this category, you might discover stocks that can increase tenfold or even 100-fold. Such companies offer significant advantages to amateur investors, who typically have smaller portfolios and only need to find 1 or 2 such stocks to significantly improve their overall performance. However, it's also important to remind you that because these companies are small and limited in strength, the risks are higher than average, and it's easy to fall into traps. The key to analyzing fast-growing companies is to assess their replicability, whether they can replicate their success in one location in other areas. For example, Walmart during its expansion phase is a classic case. As the company continued to explore new markets and rapidly increase profits, its stock price soared. Lynch believed the trick to investing in these companies was to understand when their growth phase might end and to sell the stocks before the rapid growth period ended. Next, let's look at another area where tin-baggers are common: turnaround companies. These are companies that have been severely hit, almost to the point of bankruptcy, and are struggling to recover. Investing in turnaround stocks is risky, but once a turnaround occurs, they can also become blockbuster stocks. One advantage of investing in turnaround stocks is that their price movements are very weakly correlated with the overall stock market. In the 1980s, the famous car manufacturer Chrysler was in dire straits, even on the verge of bankruptcy, but managed to recover with government support. Lynch made a lot of money for the Magellan Fund by buying Chrysler stocks. In early 1982, he started buying Chrysler stocks at $6 each, and within 5 years, their price had increased 15-fold. In addition to fast-growing and turnaround companies, another type of company that can produce tin-baggers is those with hidden assets. Lynch once visited an ordinary cattle ranch in Florida, which seemed to have nothing more than some short shrubbery, a herd of grazing cattle, and about 20 employees. The hidden asset in this case was the land itself. 10 years later, just the land alone was worth over $200 per share. This is a typical example of a company with hidden assets. Let's review Lynch's first investment principle, picking Tenbaggers. He believes that in finding blockbuster stocks, amateur investors not only do not have a disadvantage compared to professional investors, but actually have an advantage. There are three types of companies that are most likely to produce Tenbaggers: fast-growing companies, turnaround companies, and companies with hidden assets. Part 2. Now let's move on to the second investment principle, stocks to avoid. As we discussed how to pick blockbuster stocks nearby, you might feel very confident. However, it's important to remind you that in addition to stocks that can make you 10 times your money, there are many traps in the stock market that can lead to significant losses. How can you avoid these traps? Peter Lynch also summarized his very valuable lessons, and I've distilled the most important 3 points into 3 rules. Lynch's first rule is, avoid hot stocks and hot industries. This rule might seem counterintuitive, as the popular saying, "even pigs can fly in a strong wind," suggests many people are eager to chase the pigs in the wind. Why does Lynch advise us to stay away from hot stocks and hot industries? The first reason is that the hottest stocks in a hot industry have already received the most attention. Even during commutes, you might overhear people discussing these stocks in the subway. Since the level of attention is already so high, it means there are few new buyers left, and the likelihood of stock prices falling becomes greater as the number of new buyers decreases. The second reason is that hot stocks are bound to be overvalued. Over time, the bubble will inevitably burst. For example, in 2000, the internet stocks in the United States overheated and the bubble burst, causing the Nasdaq index to fall by more than half in a short period, with many stock prices dropping by 90%. The third reason is that too much capital flows into hot industries, leading to excessive competition, which likely results in companies in the industry not making money. For example, in the 1960s, the leading company in the photocopier industry, Xerox, was one of the hottest stocks in the U.S. market, highly favored by analysts. In 1972, when Xerox's stock price reached $170, analysts predicted it would continue to grow indefinitely. However, soon after, competitors like Canon, IBM, and Kodak entered the photocopier market. Quickly, about 20 companies produced photocopiers that could achieve results similar to Xerox, and Xerox's stock price eventually fell by more than 80%. Lynch's second rule is, be wary of companies touted as the next something. The market often hypes companies as the next IBM, the next Intel, or the next Disney. Lynch believes that these companies almost never truly become the star companies they are modeled after. In many industries, the top player often captures most of the market benefits, and the profitability of the second player is often far less than that of the first. Moreover, many companies touted as the next big thing often fail to even become the second player. Lynch's third rule is, beware of stocks whispered about in hushed tones. If you've ever bought stocks, you might have encountered a scenario where a friend secretly tells you, "I have a big dark horse to tell you about, but don't tell anyone else." Unfortunately, these whispered stocks have almost always led to painful lessons for Lynch. For example, the stock of National Healthcare Centers fell from $14 per share to 50 cents. Sun World Airlines stock fell from $8 per share to 50 cents, etc. Lynch believes that these whispered stocks often tell a magical story, such as a company's product that can cure AIDS or solve oil shortages. But the company itself doesn't generate significant revenue. These magical stories are almost never realized. Therefore, investing in such companies involves great risk, and you should stay as far away from them as possible. In this part, we've heard 3 rules. Don't touch hot stocks and hot industries, companies touted as the next big thing, or companies whispered about in hushed tones. Each rule is a costly lesson paid for by Lynch, and worth remembering seriously. Part 3. Now let's move on to Lynch's third investment principle, mastering the timing of buying and selling. Let's first look at two incorrect ways of buying and selling stocks. Some investors always habitually sell winners. For example, stocks whose prices have risen, while holding on to losers. For example, stocks whose prices have fallen. Lynch considers this investment strategy foolish, like pulling out flowers and watering weeds. What about the opposite? That is, selling losers, stocks whose prices have fallen, while keeping winners, stocks whose prices have risen. Lynch says that this strategy isn't much smarter. At this point, you might be confused, wondering if neither approach works, then what should you do? The reason why both strategies are problematic is that they both use current stock price changes as the main decision-making basis. Since you can't simply look at stock prices, what should you look at? Lynch says you should analyze the fundamentals of the company to see whether the stock price is high or low relative to the company's fundamentals. If the stock price is overvalued, you should sell. If it's undervalued, you should buy. This approach is very similar to the value investing strategy advocated by Buffett. Lynch also adds 2 points. There are 2 special periods when you might find particularly cheap stocks. The first period is at the end of each year when many investors sell losing stocks to reduce taxes, making it easy to pick up bargains. This is related to U.S. tax laws, which we won't go into here. The second period is during stock market crashes or major downturns, which occur every few years. This is also a good time to find bargains. For example, in October 1987, a stock market crash occurred in the United States, causing almost all company stocks to inevitably fall sharply. Earlier, we mentioned that Lynch missed a blockbuster stock in his industry, the Dreyfus Fund, because its business was rapidly growing and its stock price had risen significantly. During the stock market crash, due to the overall pessimistic sentiment in the market, the stock price of the Dreyfus Fund also fell with the market and at its lowest point. The business valuation of the company was almost equivalent to $1 per share, practically a giveaway. This was clearly an excellent investment opportunity, and Lynch seized the chance to buy this stock during the market downturn, achieving a 60% increase in its stock price within a year. After discussing the timing of buying, let's look at the timing of selling. The most common mistake investors make in selling is selling a blockbuster stock too early. Let's look at Lynch's failed case with Toys R Us, where he lost a lot of profit by selling too early. Toys R Us is an excellent toy store that expanded rapidly in the United States in the 1980s. After thorough research, Lynch bought many of its stocks at a price equivalent to $1 per share. However, shortly after his purchase, Lynch read in the newspaper that a retail magnate had bought 20% of Toys R Us stock, causing the stock price to rise. At the time, Lynch thought that once this magnate stopped buying, the stock price of Toys R Us might fall, so he sold all his stocks at around $5. By 1985, the stock price of Toys R Us had risen to $25 per share. That's right, this was a stock that increased 25-fold in just a few years. Unfortunately, Lynch only earned a 5-fold return. In contrast, his colleague Peter Lynch, who had recommended the company to Lynch and managed a fund, firmly held on to Toys R Us and eventually achieved an astonishing 25-fold investment return. This shows that when you are long-term optimistic about a company's development, you shouldn't sell its stocks for short-term reasons, because once sold, you might not be able to buy them back at the same price. At this point, you might have a question. Is there a way to sell stocks at their highest point? Unfortunately, such a method does not exist. But Lynch shared his experience in selling stocks, which is to think about when to sell stocks just like when to buy them. When to sell stocks is essentially about mastering 2 points. The first point is to review the reasons you bought the stock. If the original reason for buying no longer exists, then it's time to sell. For example, if you bought a fast-growing company's stock because the company was rapidly expanding into new markets and its profits were in a high-growth phase, then after a period of time, when the company's rapid growth has slowed, It means the original reason for buying no longer exists, and it's time to sell. Another example is if you bought a turnaround company's stock because the company was facing a crisis but had the potential to recover, and its stock price had significantly fallen. Then, after a period of time, when the company has recovered from the crisis and all its problems have been solved, and its stock price has significantly risen, it's also time to sell. This is the first point in mastering the timing of selling. What about the second point? It involves comparing the price-performance ratio of the stocks you hold with other stocks in the market. If the price-performance ratio of other stocks is significantly higher than that of the stocks you hold, you should also consider selling. We've also discussed another book on Daily Book Dive, Investing the Templeton Way, and Lynch's thinking is very consistent with Templeton's. When someone asked Templeton when to sell stocks, Templeton's answer was, "When I find a stock with a higher price-performance ratio than this one." The price-performance ratio mentioned here refers to the degree to which the stock price is undervalued relative to the company's fundamentals. The more undervalued, the better. Let's review Lynch's third investment principle, mastering the timing of buying and selling. When to sell stocks is essentially a process of returning to the original reasons for buying. Also, you can use the comparative method to see if there are other companies' stocks that are more worth your investment. In conclusion, this brings us to the end of this book and this episode's content. We've discussed Peter Lynch's 3 investment principles in total. The first principle, picking Tenbaggers. At the beginning of this book, Lynch gave all amateur investors a boost. He believes that in picking blockbuster stocks, amateur investors not only do not have a disadvantage compared to professional investors, but actually have an advantage. Of course, to leverage this advantage, you need to learn a complete set of stock picking methods, such as learning to classify companies into different types for analysis. This method is not as difficult as you might think. The second principle, stocks to avoid. While learning how to pick Tenbaggers, you also need to know how to avoid pitfalls. In this part, we discuss some stocks you should definitely avoid. By avoiding these traps, you've already succeeded halfway. The third principle, mastering the timing of trades. After discussing how to pick stocks and how to avoid traps, there's still one important issue left, which is how to choose the right timing. There's a saying in the stock market, a disciple knows how to buy, a master knows how to sell, implying that selling is often more difficult than buying. In this part, we shared Lynch's valuable experience in selling stocks, with 2 core points. When your reason for buying has disappeared, you should sell. And when you find a stock with a higher price-performance ratio, you can also consider selling. Finally, let's look at where Peter Lynch's investment method stands in the investment field. In the global investment arena, Lynch is known for his ability to invest in growth stocks, especially in picking Tenbaggers, which are often found among fast-growing companies, turnaround companies, or companies with hidden assets. Another investor, Buffett, is also known for his stock-picking ability, but he focuses more on steady growth companies and consumer goods companies. Additionally, the two differ significantly in their concentration of holdings. When they find companies they like, Lynch buys a little, while Buffett tends to invest heavily, even buying entire companies. In other words, Lynch's investment is more diversified. At one point, the Magellan Fund he managed held more than 1,500 stocks, while Buffett's investments are much more concentrated, typically holding just a few dozen stocks. However, Lynch's advice to amateur investors is that usually holding 3 to 10 stocks is enough, which coincidentally aligns with Buffett's approach. Lynch announced his retirement after managing the Magellan Fund for 13 years, citing his desire to spend more time with his family. His public performance record is only 13 years, but the 29% annual compounded return he achieved during those years has become legendary in the industry. After retiring, he devoted much of his time to charity and public welfare. Sometimes in investing, what not to do is more important than what to do, and knowing when to bravely exit is also a form of wisdom. Lastly, let's revisit Peter Lynch's well-known quote, "I want to think as much as possible like an amateur investor when picking stocks." This book is specifically written for amateur investors. If you are an amateur investor, congratulations, you've already won at the starting line. The original book link is attached at the end for further reading. You can also click the share button below the video to share this book with your friends. Congratulations, you've just finished another book.